This is a table of 10-year government bond rates. It's the annual cost of borrowing for these governments for 10 years. The United States pays an average of 4.28% interest per year to borrow money for 10 years. For China, borrowing money for 10 years costs its government just 1.7% per year. Borrowing rates in China are falling across its entire yield curve. The 2, the 10, and the 30-year bond rates are declining steeply. This means that China's government can access capital markets at less than half the cost that the United States government can. The economy here is very strong, with China's exports rising much faster than experts predicted. All this while inflation at the household and producer levels doesn't exist. Prices are falling economy-wide as factory and supply chain productivities increase. The lower cost of capital in China has important knock-on effects. This is a report on China's Belt and Road Initiative. And this analysis is quite critical, actually, of China's investments in developing economies. But they point out that China's overseas lending carries a weighted average interest rate of 4.2%. Said another way, governments in Africa and South America can borrow US dollars from banks in China at a lower interest rate than the United States government can borrow US dollars. That isn't supposed to happen, obviously. And it's the result of a perfect storm where everything is coming together for them while everything is falling apart for us at the same time. When the new Treasury Secretary, Scott Bessent, took the job, he was already concerned about the interest rate problem and how that needs to inform how the U.S. government borrows money. Treasury needs interest rates to come down before borrowing more money at longer maturities. In other words, it's getting too expensive for the U.S. government to issue debt at 10 years or longer, so they're instead planning to borrow at much shorter maturities by selling short-term bonds, T-bills, that need to be rolled over more often than once per year. President Trump agrees that until the Federal Reserve cuts interest rates and makes it less expensive to borrow for longer, then they will be borrowing much more short-term. There are some big problems with that strategy, though. First, the amount of new borrowing is just too high. The U.S. government needs to borrow $2 trillion a year. So investors are demanding higher yields anyway, no matter what the Fed does. Inflation is still running hot. Tariffs are a serious problem that are now hitting producer prices. And there is no end to these deficits, which just run higher and higher. Borrowing rates for consumers and businesses reflect all those problems. The second problem is here. The Federal Reserve can cut rates, but the Fed doesn't move the needle much for households and small businesses or for governments who want to borrow for longer than 10 years. That's because when the Fed announces a rate cut, it's referring to the rate the banks use to lend to each other, which is usually overnight. It has no effect on mortgages or on interest rates on the 10-year Treasury bonds, which are highly correlated. Mortgage rates track very closely with 10-year bond rates because banks need to borrow money long-term in order to lend long-term. The difference there between the blue line and the black shows the spread between government 10-year rates and 30-year mortgage rates. They move together. So when Jerome Powell loses his job and the new guy cuts interest rates 5 minutes later, it isn't going to matter very much to home buyers, for example. The Fed did cut rates 3 times recently, and mortgage rates didn't move. Mortgage rates stayed high because the 10-year bond yield stayed high. The reason for those high rates, these high borrowing costs for the Treasury Department, for businesses, for households, is that the country's financial position now is terrible. And these problems are structural and deep. Over the next year, the next 4 quarters, $9.2 trillion need to be refinanced. That is existing debt, which needs to be rolled over. So most of that debt was taken on when interest rates were a lot lower. So rolling over that $9 trillion is going to cost much more in interest payments than they were when first issued.